So, welcome to this presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We are going to be mixing technicals with fundamentals today, as usually. Mostly, we will be focusing on FX pairs. If we have time, we may have a look also at your stock markets, gold, and WTI. Especially WTI had an interesting movement. Should you have any trading instrument that you would like to have a look at, please mention in the comments. If we have time today, gladly we can do it. If not, we can always make time tomorrow. Starting with Euro USD, this is the daily chart. Practically all charts to be presented are to be of the same time frame unless otherwise stated. Now the pair since Thursday, when we had the last presentation, practically moved in a sideways manner. It was kind enough between the 1.0825 and the 1.0775, the R1 and the S1. The movement of the past few days, especially on Friday, which tended to imply a higher peak, or if you could allow for a slight widening of the corridor by raising the resistance line like this, and I would be raising it to the 1.0835. We're talking only about 10 pips higher, so nothing material, but it's nice, so I'm doing it. So on the one hand, the stabilization of the pair was evident practically by two elements. The first would be that the price action hit a floor at the 1.0775 support line practically on last Wednesday and remained in a corridor form between the R1 and the S1 since then. The second element would be that the stabilization of the pair's price action has breached the downward trend line, which has been guiding the pair since around, if I'm correct, the 1st. Let's have a look. The 30th of September, actually. And at the same time, the stabilization of the pair respected also to the upside some levels. So it's not like we have a reversal to the reversal of the downward motion to a bullish motion. No, we have an interruption of the downward motion plane. And I would be highlighting here that the downward motion ended once the M formation was completed by hitting the level at which it started. And that was about the first day of August, 1st of August. And practically over the past 2.5 months formed this huge double top formation. It was very telling at the time, and it was clearly the reason why we had to mention it. Now, for a bullish outlook to emerge, by that seems to be a bit remote. It's still a possibility, and since the stabilization of the pair, that possibility has increased. For bullish outlook, I would require the pair to breach the R1 1.0835 and aim, if not actually breach, also the R2 1.0885, the R2 which practically rests on these peaks here. 1, 2, 3, 4, 5, and seems to be quite solid. On the flip side, should the bears regain control of the pair over the pair's direction, we may see it breaching the S1 1.0775 and start aiming for the S2 1.0725. On fundamental level, okay, let's start with the US data. We have a number of financial releases which could be of interest for USD traders, and we're making a start on Thursday with the release of the PCE rates. It's the second inflation test for September for the US economy. A possible easing of, or let me rephrase that, a possible slowdown of the core PCE rates could be implying an easing of inflationary pressures in the US economy and practically renew pressures on the Fed to continue cutting its rates, maybe even with a faster pace. Uh, in such a case, say for example a slowdown of the core PC rates, we may see the USD weakening, which could allow the euro to rise. At the same time, we're getting also the preliminary GDP rate of the US for Q3. The rate is expected to remain unchanged at 3% year on year. And sorry, such a result, despite the lack of an acceleration, or if you prefer, further acceleration, would still support the Fed's narrative about the possibility of a soft landing of the US economy. And in my opinion, that could be supportive for the USD. I would be also highlighting on Friday the release of the US employment report for October. I expect it to be actually the crown of financial releases in the week. Forecasts are not at the best. The NFP figure is expected to drop, if I'm correct, to 115K if compared to September's 245K. So that's an issue, which tends to highlight an easing of the US employment market. Yet, nevertheless, the unemployment rate is expected to remain unchanged at 4%. And at the same time, also the average earnings growth rate is expected to remain unchanged. So we may be getting some mixed signals from the release on Friday, which, in my opinion, could still weigh on the USD somewhat. From the euro side of the pair, the case for the euro bulls is pretty hard to make, in the sense that on the monetary level, we have ECB's intentions to continue cutting rates, and even discussions among ECB policymakers for an even wider rate cut in the next meeting. In my opinion, that's not so probable. But the mere fact that ECB policymakers are discussing this, or even the press is discussing this, tends to highlight the dovish tendencies of the ECB. And that, in my opinion, tends to be weighing on the euro somewhat. That's one. On a fundamental level, the situation does not seem to be posing as well for the euro side of the pair. I would be highlighting, okay, definitely we note that there is, I wouldn't say political instability, but unrest in the eurozone. The latest, which tended to worry me, was that Volkswagen in Germany is about to close 3 factories in a cost-cutting exercise practically, which would be a substantial blow not only to the German economy but also to the morale for the German investors and, I wouldn't say market participants, but the morale of German policymakers. It's a big issue. May I also mention here that Volkswagen had never closed a German plant. As for financial releases, we're getting the GDP rates of Germany and France, the preliminary HICP rates of October for Germany, France, and the Eurozone. And practically the combination of the high impact financial releases from the Eurozone and the US at the same time, more or less in the same days, tends to highlight the interest of the market for the pair, which could be substantial up until the end of the week. Other than that, the main fundamental issue for USD, but not only for the USD, are definitely the US elections. it seems to be the case that Harris has a very, very slight a very, very slight advantage over Trump, at least according to recent polls, of 1%. However, that may be well within the statistical error. And I would be highlighting that it doesn't matter who has the most votes at the national level. The most important thing about the US elections is practically the presidential elections is getting the electorate college. And that could happen if you have fewer votes on a national level. So swing states are in focus. Now, the US elections are getting a little bit more complicated in the following sense that media are focusing practically and understandably are focusing on the presidential elections of the US on Tuesday, where you have a bipolar between Trump and Harris. But the fact is that we have also the full number of the House of Representatives seats which are to be contested, and also 1/3, if I'm correct, 34 out of 100 Senate seats are also to be contested on Tuesday. So that perplexes the situation in the following sense that we may see Trump getting elected and having full control over the US Congress. That's what we call a red sweep. We may have a second scenario where practically Trump gets elected, but the Democrats are having control over the Congress, and that could create more or less a different market reaction. A very different market reaction could also be created should Kamala Harris actually win the presidential elections, but the Democrats do not have control over Congress. And finally, a very different market reaction could be expressed should Kamala Harris actually win the presidential elections and the Democrats have full control over Congress. That's the so-called blue sweep. So we have four scenarios which could play out. However, the overall issue may be not as clean as described before. For example, we may have Kamala Harris winning the presidential elections marginally, but Trump contests the actual results. And in such a case, I expect there to be substantial unrest in the markets. In the FX market, I would be highlighting that we may see different results depending on the presidential elections. For example, the possibility of Trump getting elected may provide support for the USD and at the same time weigh on other currencies, as practically Trump is expected to maintain a very isolationist economic policy, slapping tariffs all around. On the other hand, should Kamala Harris be elected, we may see the support for the USD being moderated, if not actually weigh on the USD. While on the flip side, other currencies, especially emerging markets, may be getting some support, especially the euro. That would be another such case. So it's everything hanging in the balance. And on top of the above, we have also the US earnings reports, which tend to intensify market interest for US stock markets, and that could be practically swaying the attention away from the FX market. We are focusing on this practically on the tech sector, as we have today from Alphabet, the earnings report. We have, if I'm correct, tomorrow Meta and Microsoft. And on Thursday, we're getting Apple and Amazon. So the tech sector has always weighed substantially, now always it's a big word, at least for the past years, has weighed substantially for the US stock markets, especially after the emergence of AI. And in my opinion, I wouldn't be surprised to see increased headlines over the coming days regarding these earnings reports, which could affect the FX market indirectly as well. Now, on a technical level, once again, we mentioned Euro USD. We maintain a bias for the sideways motion as long as the price action of Euro USD remains between the R1 and the S1. For a bullish outlook, we would require the pair to rise, breach the R1, and start aiming for the R2. A bearish outlook, which, mind you, may also be supported by the RSI indicator, which has corrected a bit higher from the reading of 30, but remains still at relatively low levels, implying a possible bearish predisposition of the market for the pair. For a bearish outlook, we would require the pair to drop, break the S1 1.0775, and start aiming for the S2 1.0725, 50 pips lower. Okay, let's have a look at USDJPY. Now, USDJPY maintained an upward motion. And at this point, I would be, allow me to delete it. I want to have a look at this upward trend line. I think that's more characteristic. We maintain a bullish outlook for the pair. I think that's more than obvious. As long as the upward trend line remains above, as long as the upward trend line continues to lead USDJPY's price action. At this point, it would be interesting also to add a label in black mentioning the pair. Okay. So we maintain our bullish outlook. As mentioned before, we expect or set the next possible target for the bulls to be at the 154.8 resistance line. Practically, we highlighted this level as it provides some resistance here, some support here and here, and also some resistance here. So that seems to be pretty valid. But should the bulls maintain control, we may see the pair breaching the R1 and thus paving the way for the R2 158.35 resistance line. Mind you that the R2 has provided resistance here and here. On the flip side, before we move to the possibility of a bearish outlook, one small word of caution about the USDJPY bulls. The first would be the fact that the RSI indicator has reached and slightly surpassed the reading of 70, implying a strong bullish sentiment on behalf of the market for the pair on the one hand. On the flip side, I would start worrying about the pair being at overbought levels and possibly ripe for correction lower. And we have similar signals by the fact that the price action is nearing the upper Bollinger Band. It may slow down the bull somewhat. On a fundamental level, we already covered the USD. Okay, JPY traders have to face practically two issues. The first would be the political instability which occurred in Japan from the elections over the weekend. The Liberal Democratic Party practically lost, the coalition of the Liberal Democratic Party lost the majority it enjoyed in the parliament. And that tends to provide practically uncertain at political level for the JPY. Now, normally we would expect the safe haven qualities of the JPY to kick in. They didn't. And the reason I'm highlighting this is because there is also a wide discussion on a political level about BOJ's intentions. My worries practically are revolving around the possibility that Mr. Ishida may, in his efforts to form a new coalition, make concessions about BOJ or intensify his criticism on BOJ's intentions to actually proceed with further rate hikes. Now, BOJ hiking rates, understandably, is not something which is being seen favorably by men in Japan. And I think BOJ may face increased headwinds in its efforts to actually normalize its monetary policy. And in my opinion, that was the main issue which underpinned practically the weakening of JPY and allowed USD JPY to rise further. Now, we have also BOJ's interest rate decision. The bank may remain on hold. I think we may see BOJ trying to answer to any rumors about political pressure by underscoring its independence in the upcoming interest rate decision, and that may provide some support for JPY. We may see the bank implying that its intentions to continue normalizing its monetary policy remain, and that no political influence can sway it from its targets. So, be on the watch out. We may see BOJ's interest rate decision practically having an effect on the JPY. Actually, it's a live one in that sense. Okay, let's have a look at GBP USD. GBP USD in a sideways motion, similar to, my opinion, the euro. Okay, the stabilization is evident practically by the failure of the pair to actually reach or breach the S1 1.2890, and you can see how the pair was unable to form a lower trough than the one which was recorded on Wednesday and Thursday. So we may see the pair stabilizing, possibly between the R1 and the S1. The first signal, in my opinion, that would be exactly very, very evident of the stabilization of the pair would be a breaking of the downward trend line which has been guiding it. And that could happen within the next 48 hours. On the other hand, I would be noting that the RSI indicator has risen. It's currently at the reading of 41. On the one hand, it tends to imply an easing of the bearish tendencies or the bearish sentiment among market participants for the pair. On the other hand, though, there's still some bearish tendencies among market participants for the pair. And should the bears renew their control over the pair, say for example the downward trend line, the pre-mentioned downward trend line holds its ground and pushes the pair lower, I would require for a bearish outlook the pair to have a lower trough than this one. So it has to fall and practically break the S1 1.2890, which used to be a former resistance line. You can see it providing resistance right here. It was beautiful. And should the S1 be broken, the next possible target for the bears is being set at the 1.2675, a level which provided support here and resistance here. Should the bulls take over, Now, for bullish outlook, the breaking of the prementioned downward trend line is not enough. And to tell you the truth, I'm going to be a little bit more conservative here. Regarding a bullish outlook, I would require the pair to rise, breach the prementioned downward trend line, breach the R1, sorry, 1.3030, and start actively aiming for the 1.3260 resistance level, a level which provides resistance here. We are talking about 230 pips distance. It's pretty wide and definitely not within the day. It's going to take a week, maybe two, to reach it. So we should be sufficient for a bullish outlook should the downward trend line be broken. The price action breaches the R1 1.3030 and starts actively aiming for the R2. On a fundamental level, okay, besides there are no major financial releases which could affect the GBP side of cable, I think one factor which could weigh on the pound would be the dovish intentions of BOE. I'm highlighting this because after the considerable slowdown of the UK CPI rates, I think BOE Governor Andrew Bailey is going to be intensifying his efforts to continue cutting rates. And that could, or that prospect, could weigh on the pound somewhat. Moving now to AUD USD. Actually, USD CAD would be preferable before the Aussie. Shifting the upward trend line a bit to the right. And it's being put to the test right now. And that's being evident practically by two elements. A, the fact that we have a peak which was not able to be surpassed. Practically, the winning streak of USD CAD over the past 1, 2, 3, 4 days has been holded in today's Asian and European session. It's going to be interesting to see how the American session will be affecting the pair. Definitely, we need to switch the 1.3845 resistance line into support line. Let's go hunting for a new ultimate resistance level. Unlocking the chart, going back. Now one peak would be this one, but I'm preferring this one because we had 1, 2 touches. I know it's pretty close, but to tell you the truth, I don't care so much. I think symmetry is not of the question here. The fact that it has more touches makes it more interesting. And it's at the 1.4270 resistance line. Readjusting the chart. Let's correct also the labels. Now, CAD traders, let's talk a little bit about fundamentals as we're doing the work on the chart. CAD traders could be interested today and tomorrow, if I'm correct, at the presence of BOC Governor Tiff McClellan and BOC Senior Deputy Governor Rogers. They will be presenting before the Canadian Parliament. That's today, if I'm correct, and tomorrow before the Senate. And I would expect a dovish stance by BOC's policymakers, which in turn could weigh on the Canadian dollar and allow for USD CAD to renew its bullish tendencies. So be a bit on the watch out on that. It's in today's and tomorrow's American session. If I'm correct, we have also Canada's GDP on a month-to-month rate for August. this week, and it's expected to slow down, which could weigh also on the Canadian dollar. So that's an issue. Other than that, cat traders may be keeping an eye out on oil prices. Given that Canada is a major oil producing economy, sorry for the interlapse, but I would like to highlight the following. Note how the double bottom formation, down, up, this is the neckline, down, up again, is nearing completion. And that may allow on a technical level the pair to stabilize somewhat between the R1 and the S1. Yet, on the other hand, I would be highlighting the fact that the RSI indicator is at the reading of 70, which implies a very strong bullish sentiment on behalf of the market for the pair. At the same time, the fact that the price action of other RSI indicator has surpassed the reading of 70 may be implying that the pair is at overbought levels and may be ripe for correction lower, and that's being implied also by the very, very slight downward inclination, even if it's above 70 of the RSI indicator. On the flip side, we note that there is still some distance between the price action and the upper Bollinger Band, which implies that there is still some room for the bulls to play if they wish to. Should the bulls maintain control over the pair, we may see it breaking the R1 1.3945 and start aiming for the R2 1.4115. On the flip side, for a bearish outlook, despite that being quite improbable right now, it's still a possibility, though it should be covered. We may see USD CAD actually dropping, breaking the pre-mentioned upward trend line, signaling exactly the interruption of the upward movement, breaching also the S1 1.3845 and start aiming for the S2 1.3720. Let's have a look at the Aussie. Now, AUD USD's downward motion is clear. The pair is actually right now testing the 0.6570 support line. The RSI indicator has been nearing the reading of 30, implying and intensifying, if not even strong, bearish sentiment on behalf of the market for the pair. I would expect the downward motion to be maintained, and in such a case, we may see the pair clearly breaking the S1 0.6570, allowing it to open the gates for the S2 0.6470. Now, should the bulls take over for bullish outlook, the bar is very high. The pair would have to rise, breach the pre-mentioned upward trend line, and the first signal that the bearish movement has been interrupted. But I would require it to also breach the R1 0.6705 in order to be more certain that the bullish outlook is out there. Now, on a fundamental level, I would be noting three issues for the Aussie traders. The first issue would be the wide uncertainty the market tends to provide bearish tendencies for AUD, given that AUD is considered to be a commodity currency, thus a riskier asset. So in times of uncertainty, traders tend to divest from risky assets and invest in more safe havens. That's one. The second issue, which I would be highlighting for the Aussie, would be developments in China. Given the close Sino-Australian economic ties, let's not forget here that Australia is exporting a wide amount of raw materials, especially coal, iron ore, copper, if I'm correct, towards China. Hence, the manufacturing activity, or if you prefer, the economic activity in the manufacturing sector of China is crucial not only for China, but also for Aussie traders. And I'm highlighting here that we're getting from China the release of the October PMI figures. The NBS PMI figure for the manufacturing sector is due out on Thursday's Asian session, the last day of the month, while the Kaixing manufacturing PMI figure, also for October, is due out on Friday. So we may see some turbulence there for Aussie traders should the actual figures diverge substantially or differ, if you prefer, from the prognosis. Should they, for example, be lower than expected, substantially lower than expected, we may see the Aussie weakening further, while on the flip side, a wider improvement than expected of the figures could imply some improved economic activity for the Chinese manufacturing sector and thus provide some support for the Aussie. Yet I think the main release for Aussie traders in the week are going to be tomorrow's CPI rates for Q3 from Australia. Now the rates are expected to slow down. They're expected to slow down considerably. And if actually so, they may weigh on the Aussie as it may allow for increased market expectations for the RBA to actually ease on its hawkishness. So I would be giving close watch on that release if I was an Aussie trader tomorrow. Okay. Last but not least, one small look at WTI's price. We note how WTI's price dropped. That was on Monday's Asian session. Practically, it opened with a negative gap, and the reason why was because the Israeli hit on Iran was softer than the market may have been fearing. Practically, the Israelis targeted military facilities of Iran, and that spared practically any nuclear and any oil facilities of Iran, which would be a substantial escalation and could provoke an even wider response from Iran. So practically, the worries about the international supply line of the oil market tended to ease, and that allowed oil prices to fall somewhat. Yet, the fall as such may not have been sufficient. There is still some uncertainty in the Middle East, not some substantial uncertainty in the Middle East, and we expect things to become worse before they become better. And in such a case, we may see some bullish tendencies for oil prices. Let's have a look at gold, which is nearing record high levels. We are just before closing. Yeah, it has broken above the 2,730, and it's practically at the same level. In my opinion, this should be the actual resistance line at 2,760. Could lower this right here. Let's drill into the 1 hour chart. Could go even lower. $2,758. Practically marks a peak. In my opinion, back to the daily chart, the bullish tendencies remain. There is indicators at the reading of 70. The upward trend line remains intact. We may see some correction lower, possibly below the 2,730. But overall, the upward movement seems to be maintained for now. I wouldn't be surprised to see the precious metal reaching new record high levels within the next couple of weeks. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
This session, as I mentioned earlier, is about trend trading. So as per usual, just a disclaimer before we get started. A risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all of your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice and or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who were finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. We have quite a number of slides to get through. So if you have any questions throughout the webinar, feel free to pop them into the chat or in the Q&A session, and I'll be happy to answer any questions you have. So this is our agenda for today. Firstly, we'll go through what exactly is trend trading and how to identify a trend using trend lines and channels. And then we will look at the different indicators that you can use and how you trade using these indicators. Next, we'll look at a couple of disadvantages of trend trading and how you can overcome these disadvantages. Okay, let's get right into it. So what exactly is trend trading? So it's a popular strategy used in Forex markets by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trend trading can help you to make more informed trading decisions. So trend trading is based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. These movements can be upwards, referred to as an uptrend, or downward, which would then be referred to as a downtrend. So the goal of trend trading is to identify and capitalize on these sustained price movements. So statistically, a trend is more likely to continue than to reverse, and that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, the trend is your friend and you should never go against the trend. But of course, there are a couple of exceptions to this, so we'll talk a bit about those later on in the webinar. But the general rule is that when you follow these trends over different time frames and stay away from markets when they are not trending, then traders can then increase your profits by making these opportunities. So how exactly does it work? Excuse me. So here's just a simplified breakdown of how trend trading works and a couple of steps that you can take. So firstly would be identifying trends. So this would be an uptrend would be higher highs, and then a downtrend would then be lower lows. So this is typically done by analyzing historical price charts. Next would be your entry points. So once you've identified the trend, the next step is to find an opportune entry point. So over here, I've given an example of an uptrend. So during an uptrend, you might want to look to enter a trade and when the price has retraced slightly from its recent high. So this suggests that the trend will then continue. Alternatively, in a downtrend, you might look for a retracement before the price continues in its downward movement. Thirdly, we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So SL is stop loss, TP is take profit. Just to be sure. Okay, so a stop loss is a predetermined price at which your trade will automatically close and limit potential losses if the market moves against you. So this is also a risk management technique that we'll talk a little bit later. Next, a take profit level is where you decide to exit the trade to lock in your profits before the trade potentially reverses. Next, for number 4, we have riding the trend. So once you're in the trade, you have your risk management levels, so your stop loss, your take profit levels, all accounted for. And your trend continues, then you can aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Number 5, exit the trade. So eventually you can expect the trend to reverse or weaken. So at this point, you might decide to exit the trade and take your profits because it's important to note that trends will not last forever. So it's important to observe your trades and be vigilant and not get too greedy. Lastly, practice and analysis. So this is pretty self-explanatory. Like any trading strategy, trend trading requires practice and analysis. So you want to keep refining your skills by studying the charts and learning from your successful and unsuccessful trades. And of course, keeping updated on market news and events that could impact currency prices. Okay, so we talked a little bit about setting stop loss and take profit levels. So I just want to dive into that a little bit. So firstly, we have a retracement, which is what we talked about in the previous slide. So let's start off with pullback support and resistance. So pullback support is a strong level of support and it breaks out from a previous resistance level. Now price is dropping back to visit it again. So a tip is that when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. Here we're talking a little bit about Fibonacci levels, but if you're a bit confused about those, not to worry, we have an entire Fibonacci series on the different types of Fibonacci's. So you can go ahead and take a look at those. But the point that I'm trying to drive here is basically the introduction of a pullback support and resistance for your that could be used as your entry and exit levels. So pullback resistance works well when it breaks a significant low, as you can see from the chart here. So it breaks the level and then it makes a significant swing low and then it starts to pull back to this level. So that's why we call it a pullback. So we advise that it's even better if there are multiple Fibonacci levels that are lining up with it. So here's an example of a pullback support. Here we have 3 swing highs that line up in the same area. So remember that these are typically areas, not so much levels. So we have 3 areas that line up and price has passed through this level and it looks like it's made a swing high and it's coming back down to bounce off of this level. Excuse me. So here we have, we're expecting price to bounce off of this level, and that's why we call it a pullback, because we're expecting price to pull back to this level. So this green area here is now considered a pullback support level. Okay. Next, let's take a look at the pullback resistance example. In this example, we have 3 swing lows that line up in the same area, as you can see from this green area here. So the green area is our support, but once price breaks out of this support level, and we are expecting it to reverse off of it, then you can call it a resistance, a pullback resistance. Okay, so as you can see from the arrows, we're expecting price to pull back to this level here. So here's another example, but over here we have a actual example screenshot from a chart. So we have a swing low here and price is moving up. It's made a reversal over here. That's another way that you can identify trend reversals by looking at the swings. But we'll get into those in a little bit. So we have a swing high here, swing high reversal, it's going down, and then it surpassed the swing low support. And that's why we are expecting it to reverse back to this support level. But now that it's surpassed this level, it's now a resistance. So it is a pullback resistance in this case. Okay, next we have another pullback resistance example here. Actually, this is a follow-up from the previous slide. So this is the previous slide. We're expecting price to reverse off, and that's exactly what it did. So it reversed off of this swing low, reversed off, and it hit it right back to our pullback resistance, just as we expected. But what happens when price reverses off of this pullback resistance? So that's what we call a overlap support or resistance. So this overlap support and resistance basically occurs when price reacts off of a particular level from the top and from the bottom. So basically it means that when a swing low, as you can see from the GIF, lines up nicely with a swing high, then that's what we call an overlap level. So the more times that it reacts off of this level, the stronger the overlap area. This means that there are bulls and bears that are respecting this area. And that's why it's so important to take note of these areas. Okay, another pro tip, so if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. Okay, so here's an example of an overlap support or resistance. So it's basically a pullback support or resistance, just that price has actually reversed off of the level. Okay, so swing low support becomes a pullback resistance, as you can see from this screenshot. Once it breaks the support at this 105.643 level. So here in this GIF, you can see how price retraced back to this level or pulled back to that level, and then it proceeded to reverse off of that level. So once the reversal occurs, then it is an overlap resistance. Okay, let me know if there are any questions so far, but I hope this is pretty straightforward. Oops, sorry about that. Press the wrong button. Okay, next slide. So now we're looking at a combination of the pullback and overlap levels. So here we have a big swing high resistance level, as you can see here at the first red arrow. And then it becomes a pullback support where we expect price to pull back or retrace this level once it has passed that swing high resistance. So it surpasses it, and then we're expecting it to come back to it. And that's why it is now a pullback support. Once price actually touches that pullback support and it reverses off of it or it bounces off of it, then we can call it an overlap support instead. Okay, you can take a look here for a while and let me know if there are any questions so far. But we do have a couple more examples in case you are confused. Okay, let's move on. So here's another example. We have a multiple swing high resistance. You can see from the purple circles here, one swing high here and one swing high here. Next, at point number 2, I have an arrow indicated here. That's where price surpasses the resistance. So price surpasses the resistance and then we call it a pullback support. So you can see how the resistance then changes to a support level once price surpasses it. So we are expecting price to pull back and then it did. So point number 3, price has pulled back to our support and has in fact bounced off of it twice. So at the blue circles, you have 2 swing lows that line up nicely with these 2 swing highs originally. Once price has bounced off of this level, the 0.68745, then you can call it an overlap support. Okay. Okay, our last example before we get into how we can identify a trend. So our last example, pullback and overlap. Here we have multiple swing low supports, 1, 2 here, and then price has pulled back, or rather it has surpassed our support level, multiple swing low support. So it surpassed it, and we are expecting it to reverse back. We're expecting to reverse back because we have observed this swing low. Okay, so we observe the swing low, we see price approaching it, and we're expecting price to reverse off of it. And you can see that's exactly what happened. We have 1, 2, 3 swing highs that line up nicely, and they're all making it an overlap resistance instead. So we see price then break out of this overlap resistance one more time. In this case, since it was a resistance here, once it breaks out of that resistance, it's now a support level. And as usual, we're expecting it to pull back, which is why point number 4, it's a pullback support. And lastly, point number 5, price has pulled back to our support and reversed off of it, making it an overlap support. So you can see the swing low here, reversing right at the exact same 33420 support level. Okay, any questions so far? Okay, okay, no questions. Let's move on to our next part of the webinar. How do you identify a trend? So this brings us to our next point, which is identifying trend lines as well as trend channels. So these can really help you to identify a trend. But how you identify a trend is pretty straightforward just by looking at a chart. I'm sure you can tell whether price is moving up or down. And it's also important to note that you should be looking at the different time frames for the specific asset that you are looking at and not just at the time frame that you are analyzing. So it's important to get an overall view of the direction of where prices are headed towards. So upwards, downwards, or ranging. Okay, so let's get into how we can draw valid ascending trend lines. So ascending trend lines should be drawn from the bottom and not from the top. So here we have an example. And trend lines should also have at least 3 significant touches in order to be considered valid. Because 2 touches tend to be more coincidental, and that's why we go for at least 3. Okay, here's a couple of examples to show you how significant exactly these swing lows should be. So I have one really big swing low here and one swing low here. So that's how clear your charts should be when you are analyzing for trend lines and trend channels. Here we have another example, 3 trend lines, or rather 3 points touching the trend line. Actually, we have another small point here. And now for descending trend lines. So same thing, a descending trend line should have at least 3 significant touches as well. But for descending trend line, the lines should be drawn from the top and not from the bottom. Okay, here's an example. Here we have really nice 4 swing highs that touch our trend line. Okay, once again, take note of how clear the price movement should be. Yeah, you want to look for something with really clear movement in price. You can see exactly where the peaks are and the troughs are. Here's another example of a descending trend line. So you want to watch out for at least 3 significant touches in order for it to be considered a valid trend line. And here you see price playing the reaction of the 4th touch. So it is breaking out of the 4th touch, 4th swing high on this trend line. Okay, so here we have a little activity. Let me know in the chat or in the Q&A session if you think this trend line is valid or not. In this case, of course, we can all agree that price is moving downwards. So we are expecting to draw a descending trend line. So let me know if you think this trend line is valid or not. Okay, so this trend line is not valid because remember for descending trend lines, we want to make sure that we draw the line on top of the charts. Okay, next, let's take a look at drawing valid channels. So channels typically require at least 4 significant touches to be considered valid. You need 2 at the top and 2 at the bottom. But they don't have to be in consecutive order like what we see in the picture here. Okay, so here are some examples. We have a descending trend channel here. Remember, 2 touches on top, 2 touches below. And once again, take note of how clear the charts, or rather how clear the price movements should be. Here we have an ascending trend channel. So, of course, it doesn't have to be in consecutive order as we mentioned earlier. Doesn't have to be in consecutive order. You can have some price movement in the middle. But as long as there are 2 touches on top and 2 below, then it's considered a valid trend channel. So these are just some graphical tools that you can use when you're trying to identify a trend. And this is typically the first step whenever we want to analyze a chart. So if we have time after the slides, I'll go through maybe one setup. I think we only have time for 1 or 2 setups. So but I'll definitely go through the different steps that you can take to identify a trend and how exactly you can use that in your trading strategy. Okay. Next, we have the different indicators that you can use to identify the trend. So we're going to be talking about the different indicators that you guys can use, but let me know in the chat what are your favorite indicators to use. Yeah, just curious to know how many of you guys actually use some of these trend indicators. Firstly, we have the Ichimoku cloud. So I'll just briefly go through how exactly you can use the Ichimoku indicator. But I wanted to mention that this is not a webinar for Ichimoku strategies. So we have another webinar that is solely about how we can use Ichimoku, not just the cloud, but the different lines involved as well that I'm going to talk about in the next few slides. So you can go ahead and take a look at that webinar instead. But for this webinar, I'll just be breaking down the different lines and giving you a summary of how exactly you can use it. Okay, so the Ichimoku Kinko Hyo is a technical analysis tool that's used in Forex trading. So it consists of several elements, several components, including the Tenkan Sen, the Kijun Sen, Senko Span A and B, and the Chikou Span. Okay, I hope I'm pronouncing those right. But basically these lines include a 9-period average, 26-period average, average of these two averages, 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. And how people use Ichimoku for trading is basically 1, to identify trends, 2, as support and resistance, and 3, confirmation, as well as buy and sell signals. So if we're just looking at the cloud only, which is the most, I guess is the fastest way, because you just look at it at one glance, it tells you exactly what the indicator signals are. So over here, I'm telling you guys that when price is below the cloud, then the trend is downwards, or it's suggesting a downward trend. When the price is above the cloud, then the trend is typically upwards. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud will be moving up, or during a downtrend, then the bottom of the cloud will be moving down. So the top of the cloud, the bottom of the cloud, these both have names as well. So you can see over here. So we have the Tenkan-sen, which is the conversion line, which is the average of the highest high and the lowest low over 9 periods. The Kijun-sen, or the standard line or baseline, is the average of the highest high and the lowest low over the past 26 periods. Chikou span, which is the lagging span, is the current closing price plotted 26 periods behind the current time. So these are pretty technical meanings of what the lines mean. So, but we typically will only look at the cloud. It depends on your own trading strategy. Okay, next we have explaining the lines. Oh, I didn't talk about the Senko span. Okay, so Senko span A, or the leading span A, is the average of the conversion line and the baseline plotted 26 periods ahead of the current time. And that is a leading indicator of the trend. For Senko span B, D is the average of the highest and the lowest low of the past 52 periods plotted 26 periods ahead of the current time and used as a leading indicator as well. Okay, next we have explaining the lines and identifying trends. So here we get into what each of the lines, or rather how you can use each of these lines. So the first way is to use Ichimoku to identify trends. which the Tenkan Sen and the Kijun Sen can help you with. So a bullish trend occurs when the Tenkan Sen is above the Kijun Sen. So Tenkan Sen is the conversion line and the Kijun Sen is the baseline. Yes, correct. Okay, so over here in the chart that I've included, the Tenkan Sen is the blue line or conversion line, and the Kijun Sen is the red line or the baseline. So bullish trend occurs when the blue line crosses above the red line. And then a bearish trend occurs when the blue line crosses below the red line. Okay, next, the second way is for support and resistance. So this is just extra. So the first way was to identify the trends. Now the second way is to identify potential support and resistance levels. So the Senko span A and B, which I mentioned earlier, are the leading indicators. These can determine support and resistance levels. So if the price is above Senko span A and B, then it's considered to be a bullish market. So in this case, Senko span A and B, as you can see in the screenshot that I took from TradingView, you can see that these outline the clouds. So it's basically used as the same way as I mentioned earlier. When price moves above the cloud, it's bullish. When price moves below the cloud, then it's considered bearish. So same thing, if price moves below Senko span A and B, it's considered a bearish market. And these lines can also act as resistance levels, since they are specific levels, as you can see here. Okay, so second use of Ichimoku, first use was to identify trends, and second use is as support and resistance. Okay, thirdly is for confirmation. So the Chikou span is used to confirm the signals that's generated by the Tenkan Sen, Kijun Sen, and Senko span. So the Chikou span is the lagging indicator here. And you can see I've shown you guys what it looks like on TradingView. So it confirms if it's above the current price, then it confirms a bullish trend. And if the blue line is below the price, then it is a bearish trend. So we just use this for confirmation of the trend. So after you've analyzed or you've gone through the first two steps, so you identify the trend and we analyze the different lines, then this would be the third way to confirm the trend. Okay. Next, we have as buy and sell signals. So these depend on the positions of the various components. So for example, if a buy signal is generated when the Tenkan Sen crosses above the Kijun Sen, and a sell signal is generated when the Tenkan Sen crosses below the Kijun Sen. Okay, so all of these different lines can, when you analyze each of them, if they all line up nicely, then you have a very strong either bearish or bullish signal. Okay, so how do we use the indicator, the Ichimoku indicator effectively? So the overall trend is up when the price is above the cloud and down when price is below the cloud. So traders will often just use the Ichimoku cloud as an area of support and resistance depending on the relative location of the price, which is what we talked about in the second step, and we've shown you how to do this as well. So the cloud provides support and resistance levels that can then be projected into the future. So this is what sets the Ichimoku cloud apart from the other technical indicators that only provide support and resistance levels for the current date and time. So as I mentioned earlier, we like to typically just look at the cloud if you are looking for an indicator that's very easy to read, or you cannot, you don't really have the time to analyze each of the lines. Oop. Okay, so yeah, as I mentioned, this is how we use it by just looking at the cloud strength. So price is moving below the cloud, giving us a bearish signal. Here, when price crosses over, this is where we see a trend reversal, and you can see exactly right when this happens, price moves in an uptrend, and it's also moving above the Ichimoku cloud. So it's all very bullish signals. So this is what you want to look for whenever you are using the Ichimoku cloud. Okay, so far, if there are any questions, feel free to let me know in the chat. Okay, if there are no questions, we'll move on to our next indicator that we're gonna look at. So in this example, we're gonna look at using the moving average indicator. So price XMA is a cross-trading technique that is quite simple to use. So it involves using two moving averages of different periods to analyze price movements and generate buy or sell signals. So if you're unfamiliar, just a brief introduction to moving average indicator. So the moving average is basically a smoothened line, as you can see here. It's a smooth line that represents the average price over a specific number of periods, of which you can control when you're using MT4, MT5, or TradingView. So it helps to smooth out price fluctuations and highlight the underlying trend. So there are a couple of steps for this strategy. Firstly, you choose two moving averages. For example, here we are using a shorter period moving average, which is 20-day, and a longer period moving average, 50-day. The buy signal occurs when the shorter moving average, so in our case, the 20-day, crosses above the longer moving average, suggesting a upward trend. So in that case, we would then consider buying. For a sell signal, when the shorter MA crosses below the longer MA, then it indicates a possible downward trend, and then we will consider selling. So simply put, if your 20-day moving average crosses above the 50-day moving average, it's a buy signal. If the 20-day moving average crosses below the 50-day moving average, it's then a sell signal. So this works best in trending markets, so either moving upwards or downwards. It can produce false signals in choppy or sideways markets, so it's essential to practice and consider other factors like market conditions, risk management, and other confirmation indicators before making these trading decisions. Okay, next, let's take a look at Golden Death Cross. So this is a trading strategy that's based on the intersection of two important moving averages on a price chart. So it's a term used to describe the point at which a shorter term moving average crosses above a longer term moving average. So it indicates a potential bullish trend reversal. Conversely, you can see over here, so when price moves above, it's positive, and in this case, over here, we can then expect it to be bearish. Okay, when the death cross, The death cross will be over here when the shorter term moving average crosses below the longer term moving average, then it indicates a potential bearish trend reversal. Okay, so over here we have the golden cross and here we have the death cross. My last point is confirmation and analysis. So it's important to note that these signals are not foolproof, so you should be using them in combination with the different technical analysis tools as well, like Ichimoku, and a couple of indicators that we're going to talk about in the next few slides. Okay. Next, we have channels. So we already talked about this earlier, but here I've highlighted a resistance level from the previous touch on the trend channel. So at this level, this is my resistance, and you can see price from the swing high, price has actually touched this level, making it an overlap support. But then we see it drop down again, touch the bottom of the channel, and then it's moving within this channel. So since it's continuously moving, and you can see for a really long time, this has really clear upside, or rather upward pressure. And that's why once price breaks through this overlap support or now resistance, then we can say that we can expect it to continue within this upward channel. Okay, so let me know in the chat which one of these looks better to you. Yeah, so the first one definitely looks better. And here we're using a moving average, natural moving average. Okay, let me show you guys the next slide. So now I'm using the natural moving average, and you can see I completely agree the first one definitely looks better. And the reason for this is because price has touched this level many times before it crosses over. So this is actually maybe a better representation of what we can expect for a reversal, or rather how we can identify a trend reversal. Since price has touched it so many times, showing us a really clear upward movement, then whenever there is a crossover over the natural moving average, then we can expect the reversal to be pretty significant. Over here, it's not that this chart is bad. Of course, we're using the same indicator, it's showing us the same things, but the difference between the two is just basically the settings, which is why it doesn't fit as nicely as the first chart. So in this one, once price reverses over here, you can't really tell whether price is actually going to reverse or if it's going to continue in the upward trend. Double break. Simply put, we are just looking for a break out of the trend channel. So this is a very obvious sign that the trend is about to reverse. Once we see this very clear, so we have the natural moving average again, which is the black line, and we are also combining this with our trend channel. So as I mentioned earlier, we need 2 touches at least on top, 2 touches at the bottom at least. So very clear upward pressure here. Looks like it's going to continue. But how we know price is actually going to break out is once we have double confirmation from the crossover on the natural moving average and also breaking out of this ascending trend channel. Okay, so you can see that's exactly what happened. It fell really sharply after that. Okay, next we have confluence. So the first chart, I'm just using a ascending trend channel. And then over here, I've included the trend natural moving average. So by making use of more than one indicator, or I guess trend channel would be a graphical analysis tool. So by combining all of these tools, then you can really increase your chances of making profit or getting out of a trade if the trend reverses. So that's what we mean by confluence. Here we show you some more examples. From the previous slide, we only had the natural moving average as well as the ascending trend channel. Now we've included the Ichimoku cloud, also giving us bullish signal. And now I'm also using the golden cross or death cross technique. Okay, but all pretty bullish over here in this case. Next slide, I'm also using these same indicators here. It's just to show you guys what each of these mean. So because so many of our indicators are giving us this bullish signal, then we can expect price to continue within this ascending trend channel because there are no signs that it's going to break out. So here we can see that's exactly what it did. It bounced off of the bottom of the trend channel and it's continuing within it. Okay, let me know if there are any questions so far. Okay, I have a question. Does this work only for trending markets? So that's a really good question. And the answer to that is we typically would advise to only trade or go in for the trade when markets are trending. And the reason for this is because, and when I say trending, I mean upwards or downwards. Because if it's ranging, there's not much market movement and you cannot really make much money from ranging markets, if that makes sense, because the movements in the markets are what makes you your profits. So all of these techniques that I've gone through today are mostly for trending markets, or not mostly, are all for trending markets, because that's what we typically recommend you to go for, especially if you are a beginner trader, because it's easier to trade when prices are moving up or down as opposed to staying ranging. Okay, I hope that answered your question, but thank you so much for the question. Okay, let's move on. I just have a couple more slides and then I think we can call it a day. So next, let's go through a couple of disadvantages of trend trading and how exactly you can overcome these disadvantages. So firstly, we have false signals. So trend trading can generate false signals as well, especially during periods of market consolidation or trend reversals. So if you act on these incorrect trend assumptions, then it can definitely lead to losses. Next, we have late entries. So what we mean by this is when a trend following strategies may result in entering trades after the trend has already been established. So you can miss out on the initial price movement and potential profits. And then you might see yourself in a position where price is already reversing when you enter the trade. Choppiness is our third disadvantage. So although I mentioned that we are looking for trending markets, you want to stay away from really volatile or choppy markets because these trends tend to be short-lived and erratic, leading to frequent changes in direction and difficulty in capitalizing on sustained trends. So whipsaw trades is a phrase that describes when traders enter and exit positions quickly due to volatile price movements. So these can result in losses, and this typically occurs when rapid changes in price direction occur. So that's pretty similar to choppiness. So don't mistake when I say trending markets, don't mistake that for choppy markets. Okay, limited profits in ranging markets. So this is also part of my answer to the question from earlier. So trend trading might struggle to generate profits in markets that lack a clear and sustained trend because these trades may get caught in a range-bound price movement. Okay, requires timely decision making. So when you identify the start and the end of trends accurately, this is pretty difficult to do. So it requires timely decision making and constant monitoring, which may not suit all traders' lifestyles or availabilities. So it really depends on your own trading strategy, whether you are a scalper or if you're in it for the long run. Noisy price data is pretty related to choppiness, so I'll just briefly talk about it. In this case, we're talking about noisy price data or short-term fluctuations, leading to misinterpretation of the underlying trend direction. So how exactly can we overcome these disadvantages? So to overcome these advantages, you can adopt a couple of strategies and techniques. Firstly would be confirmation signals. So we've talked about, for example, for Ichimoku, we're talking about the different lines and what they represent. So these can be used as confirmation signals, or you can use additional technical indicators or chart patterns like we saw earlier when we're talking about confluence and using different indicators to support a trade or to support a trend. So when you use multiple indicators and technical analysis tools to confirm your trend signals before entering a trade, it can help to filter out any false signals and also increase the accuracy of trade entries. Diversification. So you should combine trend trading with other trading styles or strategies to mitigate the risk and reduce reliance on a single approach. So pretty similar to what I talked about confluence. Next, time frame analysis. So I'll talk about this really quickly in the next few slides. Risk management, we talked about this as well, implementing strict risk management techniques such as setting stop loss, orders, and position sizing based on your risk tolerance. Backtesting and optimization, we have a webinar on this, so you can go ahead and take a look. And market monitoring, it's important. Basically, we're talking about fundamental analysis, and it's really important to regularly monitor the financial events and economic data releases. Okay, so I wanted to talk a bit about time frame analysis. Here we have a very unclear market structure on the M15 timeframe. And there's no clear movements in price. So I talked a bit about that in the previous slides when we're talking about, I think it was support and resistance levels. Next, when we change the same asset or the same price chart to a H1 view, we see it a lot clearer. So there's two criterion you should look out for. Firstly, clear swing high or swing low. Secondly, a clear trend between the starting and ending points. So you can see here I've added a little quote at the very basics. The clearer the swing low and swing high, the clearer the trend between these 2 points, then the more accurate your analysis will be. So this is just an intro, but we have an entire webinar on multi-time frame analysis. But basically, it just involves analyzing the market from multiple time frames. So that's what we're talking about. Okay, so a couple of things to look out for on the higher time frames. We have the key graphical levels, so your support and resistance levels that we mentioned earlier, trend lines, trend channels, breakouts of these trends, and then big moving averages. We talked about those, Ichimoku cloud, big Fibonacci levels, and price action. So what we mean by price action is past, present, future prices, and the momentum from previous bars to dictate your strategy. So you can see how this all ties in. Basically, as long as you use multiple indicators, look at the different time frames, then you can increase your chances of making a profitable trade and trading according to trends. Okay, that's all the time I have for today. And just nice, we are done with our slides. So thank you guys so much for joining me today. I hope you guys found it helpful, and I will see you guys next week. Bye.